Well, hello everyone and welcome to Momentum channel. In this video, we're going to take a look at two undervalued dividend stocks in the communication sector that do pay their dividend and are considered to be safe dividend payers. Without any further ado, let's get into it. The first company to review is a company called Verizon, which is a renowned communications company formed in 2000 when telecom giants Bell Atlantic and GTE merged in a $52 billion transaction. The company invests more than $15 billion annually to increase their capacity and reliability of its wireless networks, and thanks to these massive investments in their capital equipment and spectrum licenses, Verizon typically delivers industry-leading wireless reliability, speed, and network performance. Verizon is traded on New York Stock Exchange with ticker symbol VZ and is currently showing to be having a very safe dividend score of 87. Their dividend yield currently sitting at 4.74%, and the company has a beta or volatility measure of 0.37, which is considered to be very low. In other words, it's considered to be very low volatility when you compare that to that of a general stock market. Verizon has a market capitalization of $225 billion, making it a mega cap company. From overall perspective, Verizon seems likely to remain a reliable income stock, and the company's scale, hard to replicate network assets, and mission critical services, and their brand recognition and massive subscriber base should remain as important competitive advantage for Verizon moving forward. Looking at some of the key metrics from a dividends perspective, Verizon has a payout ratio of 49%, which is considered to be very low for telecoms, and is actually a good sign because it gives Verizon a lot of room to grow its dividend. And that being said, though, if you look at the dividend growth rate for the stock, the latest you can see in September is showing to be only about 2% kind of year over year growth in terms of their dividend amount payments. And over past 5 years, their dividend growth rate is also annually 2% per year, which is considered to be very slow. In that sense, this is not one of those companies that currently, at least over this past 5 years, 20 years, or even most recently, is that aggressively growing its dividend. It's more of a reliable dividend payer, but not much of a fast dividend grower. If we look at the performance of the company during the recession of 2007-2009, their sales went down by only about 1.2%, which is actually remarkable. It's considered to be above average growth during the 2007-2009 recession years, but their stock went down by 38%. Although it's quite negative, and maybe it doesn't sound remarkable at all, it is worth mentioning that performance in this stock was better than that of the overall S&P 500s, whereby the S&P 500 companies went down by on average 55% during the recession of 2007 to 2009. Looking at the dividend growth streak for the stock, they have continuously increased their dividend year after year for the past 14 years. That said, over the past 30 years, they have been paying a dividend without any reduction. And as we mentioned, of which the years, 14 years of them, the last 14 years have been year after year increasing their dividend. Verizon does pay its dividend on a quarterly basis in the month of February, May, August, and November, and currently they pay their annual dividend amount of $2.56 per share. This is the accumulation of the 4 quarterly dividend amounts, and if you add them up, that results in an annual payout equaling $2.56 per share. Let us take a look at the valuation metrics. Verizon's current dividend yield of 4.74% is about in line with their 5-year average of 4.43%. This is showcased in the graph here that I'm pointing out. This suggests that the stock may be reasonably valued today. However, it is also worth mentioning that their forward price to earnings ratio of 10.2 is well below their own 5-year average of 11.9, and definitely also well below that of communication sector average. In these cases, it's worth mentioning that the usually low price to earnings ratio often indicates that the earnings could be near a cyclical peak, or that investors may believe that the firm's long-term prospects for growth have weakened. A very low price to earnings ratio does not always necessarily signal a cheap stock, and you got to be mindful of that and look at the number of other financial metrics to assess the stock. That's why we're going to take a look at the earnings per share for the company and a number of other charts in a moment to have a closer look at that. It is worth also mentioning though that Verizon is currently kind of trading very close to its actually 52-week low price. In fact, today they have hit their 52-week lowest price. The highest price that they've had in the past 1 year was at $61.74. This could present an interesting opportunity potentially for long-term investors to have their shares of Verizon and kind of add to their existing shares, or perhaps buy those, or perhaps keep an eye on it if that's something that interests them from adding it to their watch list perspective. We're going to take a look at the number of other financial metrics. As I pointed out, earnings per share, it's very promising to see how Verizon has been continuously growing its earnings per share. There are some years that, like for example, 2016 or 17, that went down, but since 2018, they've had the huge jump. There's a little bit of that cyclicality to some extent. It's like after several years, they kind of enter a new kind of level altogether. Look at since 2012 and 2013, there was a considerable jump from 2024 cents earnings per share to 2084, from there to the $3 range and then $4 range, now closer to $5. In the next 12 months, the anticipated earnings per share for Verizon is at $5.31, which is the highest amount in the past 10 years. In terms of the outstanding shares, ideally we would like to see the company that has its number of shares declining, or at least if it's increasing, it's not rapid increase year after year. It seems that for the past 6 years or so, Verizon has kind of maintained its number of outstanding shares. In the last 12 months, it maintained at $4.14 million, which is very similar to that of 2019 and 2020. Their total sales is continuously increasing. That's another metric that is important for us. You want to ideally see a company that gradually but consistently increases its revenues, and that's the case. You see the last 12 months, the company has reported $133 million in total sales or revenue, which is the highest amount since the past 10 years. We wanted to also take a look at the earnings per share from a different perspective. Well, we saw the earnings per share overall. We want to see how it's kind of the growth and declines. You'd see over the past 10 years, there were only 3 instances of decline in earnings per share. Other than that, year after year, they are showing that increases. And even the years that, for example, 2017, when they had that 3% decline, the year after they knocked it out of the park with a 26% increase in earnings per share. That's something for us to be mindful of. Lastly, we're going to take a look at return on equity. And for telecommunications company, we would like to see them having their return on equity above 11%. It is a measure of how many dollars of profit a company earns for every $1 shareholders have invested in the firm. And in this case, we see that for the last 12 months for Verizon, their return on equity is close to 30%. And for all the past 10 years, this earnings return on equity is actually always over 11%, which is quite a solid sign for us again. We're going to take a look at the stock price and how it's returned over the past 1 year as well as the past 5 years. The graph on the top left shows the past 1 year. At the time of making this video, in the past 1 year, the stock has been down by 9.15%. Again, suggesting it could be an interesting time to look into the company. Look at it. The pricing is almost close to the pricing that we had during the lows of March of 2020, February of 2021, whereby the stock had gone almost closer to that $54 mark. Now, fast forward in several months, we've got to that point. Could present an interesting opportunity. The past 5-year return for the stock is showing to be up by 8.19%. Now, granted, if you bought the stock for the past 5 years, maybe you were only up by 8%. Here, you're probably counting more so on that juicy dividend that the Verizon is paying, the reliable dividend, not too much on necessarily their appreciation. All right, well, let's take a look at some of the expectation and analyst forecast on the pricing of Verizon. There are 9 analysts on tip ranks covering the stock, with 5 of them having a buy rating and 4 of them having a hold rating, giving it a moderate buy. The average price target in 1 year for the stock, according to these analysts, is at $62.75. If that holds true, that shows an upside of 16% plus for Verizon in a 1 year time frame. Looking at analysts on Yahoo Finance, the 1 year price target for the stock is at $60.52. Again, showing some nice upside of over 10%. And lastly, if you look at the analyst on Simply Wall Street, they were showing the fair valuation for the stock to be at $165.19, which shows the stock to be undervalued by 67%. I, for one, find it a little bit too good to be true. 165 fair valuation for Verizon, I find it very excessive, but at the same time, Simply Wall Street uses different calculations to come to the fair valuation for the stock, and it's worthwhile for us to take a look at it. We want to always have that in mind and see what is the fair valuation for the stock according to those research done by Simply Wall Street analysts, and different point of view and the different point of analysis for us to be mindful of. With that, before we look at the second and last stock from a communications perspective with a high dividend, I wanted to ask you for a big favor. Here on Momentum channel, we post every week several videos about investing and ways to reach financial freedom. And we really appreciate if you can give this video a thumbs up and subscribe to our channel for more videos. It really means a lot to us and really would help the channel to grow. Thank you very much. With that, let us move on to the second stock. This is a Canadian company, and it is traded both on New York Stock Exchange as well as on Toronto Stock Exchange. So for Canadian investors, I encourage you to look up this company on Toronto Stock Exchange. It is available with ticker symbol T. For investors outside of Canada, if you're interested to get a hold of this interesting company, very, very unique company, telecommunication company called Telus, you could find it on New York Stock Exchange with ticker symbol TU. Telus began its journey over 100 years ago as a telephone service provider operated by the Canadian province of Alberta, and it wasn't until 1990 when the government privatized the business that today stands as one of Canada's largest telecommunication providers. Telus' wireless network covers 99% of the Canadian population, of which over 25% have a mobile subscription with Telus. So they have around 25% of the market share when it comes to mobile subscription. Furthermore, the company has experienced industry-leading customer retention rates, providing additional evidence of the quality of its network, and Telus operates in a stable and recession-proof industry whose importance to consumer continues to grow as we become more dependent on network connectivity in the home and the workplace. What's also so unique about Telus is that they've definitely expanded their presence. They are active, as you can see, in the health care field through offering remote virtual health. They're also providing technology solutions to agricultural fields as well as to businesses. So they're definitely expanding on their service offerings, and that's a unique case when it comes to Telus and their presence here in Canada. You can also see that their dividend growth also is showing to be average with a 5% dividend growth. They are considered to be less volatile than the general market as they have a beta score of 0.59. Telus is a large cap company with $29.7 billion in market cap, and their dividend yield currently is at 4.63%. The firm is likely to continue its dividend growth streak that started in 2004, despite a slower pace while continuing its 5G and fiber optic cable expansion. Looking at some key metrics, for the company, their payout ratio is at 121%, which is considered to be very high for telecoms. But keep in mind that their forward payout ratio is at 109%, which is a little bit better, though still a lot higher. And typically, we don't want to see a company that has over 100% payout ratio. Nonetheless, there are different considerations, and it's worthwhile for us to take a closer look at some of the other metrics for the company to get a better idea of whether this is a big red flag for us or it's just something that the company is actually able to sustain over the long term. The truth of the matter is that the company has been paying its dividend without any reduction for the past 18 years. And not only that, they've actually grown their dividend gradually. And look at the dividend growth over the past 1 year has been by 5%. In the last 5 years, they have grown their dividend annually by about, on average, 7%. And over the last 20 years, on average, every year, they've grown their dividend by 6%. So that's some remarkable numbers there. They've paid their dividend uninterrupted for the past 18 years, of which past 17 years have been consecutive increases year after year. Telus pays its dividend quarterly in the months of January, April, and July, and October, and their annual payout is at $1.02. From a valuation perspective, Telus' current dividend yield of 4.63% is about in line with their 5-year average of 4.57%. This suggests that the stock may be reasonably valued today. However, it's worth noticing that their forward price to earnings ratio of 23.2 is well above their own 5-year average of 16.6, indicating that the stock looks somewhat expensive compared to how the market has valued it in the recent years. These conflicting situations usually often arise when the stock's price rises significantly faster than its earnings, and you can check the strengths of Telus according to the 52-week price. If you look at it, the price of $21.96 at the time of making this video is definitely closer to the 52-week high price of $23.60, and a little bit further away from their 52-week low price of $17.02. The outlook for with that being said, if you believe that the company's long-term outlook for profitable growth has improved, then this higher valuation may make sense. Otherwise, it might make sense for you to wait for some pullback before you pull the trigger and kind of invest in the company. Looking at some other financial metrics from an earnings per share, ideally we would like to see continuously growing earnings per share here. You notice that the year 2020, which was a difficult year for many companies, their earnings per share definitely declined. In the last 12 months also was showing to be at $1.03, but in the next 12 month projection is that the company will improve its earnings per share. It's not going to go back as high as it was in 2017, 18, 19 or 20 or so, but definitely showing about 15% improvement compared to the past. So we are seeing that some of those improvement signs there. In terms of number of outstanding shares, Telus has maintained its number of outstanding shares over the past 10 years. It had decreased it at one point, but it's gone up, but still hovering around the same amount of outstanding shares that it had 10 years ago at 1.31 billion shares, at 1.31 billion outstanding shares that it has showing over the last 12 months. And their total sales, definitely you see that the nice consistent increase year after year. And the last 12 months, they are showing to be having $16.2 billion in total sales. And lastly, from a return on equity perspective, for telecoms, we want to see that 11% above. The last 12 months, they have kind of declined. They are showing a 9% return on equity. But other than that, since 2011 all the way until 2019, they've well stayed above that 11% mark for return on equity. Looking at the stock price return in the past 1 year for the stock on New York Stock Exchange, you're showing 24.63%. Telus is definitely considered to be one of those more of a growth stocks, dividend payer stocks. It still has a lot of room given that they're massively increasing and they're expanding their business into various kind of technology fields related to use of communications. That's why it's really a smart move for many investors actually who've been able to invest in the company since 5 years ago. Look at those returns. The past 5 years, you're seeing an overall return of 37.94%. It's not taking into account your dividend amounts. All those dividend returns are to be added on top if you want to get a full picture of your overall return. The graph on the right side is showing you the past 5-year return for Canadian investors. If you had invested in Telus in Canadian stock, in Toronto Stock Exchange, the past 5 years, it would have shown you a 31.63%. It's not exactly the same at close to 38% that you saw for the Telus on the US stock, but it has a lot of different reasons. It has to do with for instance, your currency conversion rates and some other reasons. Nonetheless, that is the return that we wanted to show here for Canadian investors. Lastly, we're going to take a look at the stock price projections by analysts. There are 8 analysts on TechRanks covering this stock. 7 of them have a buy rating, 1 of them having a hold rating, with the average price target of $24.42 US dollars. That shows an upside of 11.20% for this stock. From analysts on Yahoo Finance, they are showing the price target of $24.51, which if you compare to that of TechRanks, very, very similar, $24.42, here $24.51. And lastly, if you look at the analysts on Simply Wall Street, they are showing the fair valuation for Telus to be at $70.60 USD, and showing the stock to be undervalued by 69.1%. Well, there you have it, folks. A quick look at 2 undervalued dividend stocks in telecommunications sector, in communication sector, that I hope you find valuable information. Both of these stocks pay closer to 4.5% in dividend and have been paying their dividend reliably for many, many years. I hope you found this video beneficial and gained something of value from it. If you did, please don't forget to give this video a thumbs up and share it with someone who might benefit from the video as well. Now, of course, don't forget to subscribe to Momentum channel. Here on Momentum, we post every week several videos about investing in the stock market and ways to reach financial freedom. Let me know in the comment section down below, are you invested in any of these two stocks or any other dividend stocks in communication sector? I would love to hear from you, so be sure to leave us a comment down below. With that, thank you so much, and we hope to see you next time.